Okay, we'll get started now. Thanks for joining us. This is a webinar presented by Lucena Research. I'm Tucker Balch, CTO of Lucena, and today we're going to talk about the event analyzer and actually the science behind it. This is one of the first of two parts. We're going to dig into the history of event studies and event analysis in this first webinar. And in the next webinar, when we roll out our new product, the Event Analyzer, which is coming up very soon, we'll dive into the details of that and how it works. Now, a few disclaimers we have to cover first. First, Lucena Research does not provide investing advice. We're not registered investment advisors. Don't assume that the methods we're showing will be profitable. And finally, the results that we're going to show you here are hypothetical, and past performance does not predict future performance. So keep that in mind as you listen. Now, Lucena Research is a Georgia Tech spin-off company. We're located in Atlanta. Aris Katz is our CEO, and I'm Tucker Balch, CTO of Lucena Research. That's me. I'm an associate professor at Georgia Tech, where I teach courses in AI and finance. I've been a consultant for a #1 Barron's online broker. Also, I spent a year as a quant at a hedge fund, and I enjoyed that so much I've actually redirected my AI research towards finance, and that's one of the reasons I was really excited to start Lucena Research. And I'm CTO and co-founder of Lucena now. Okay, here's an overview. I'm going to aim for this to run just about 30 minutes. And like I said, this is first of two parts. We'll start with a background of event analysis, what it is. We're going to talk a little bit about the efficient markets hypothesis, because that's very important and relates to this. We'll dig into the details of how you conduct an event study and why it's important. And we'll also take some time for questions towards the end. So if you have questions, please feel free to type them into that questions panel on your GoToWebinar application. Now, the Event Analyzer is part of a suite of products. There's 4 of them out now that are integrated with our flagship called QuantDesk. We have a machine learning-based priced forecaster. We've got a portfolio optimizer that sets allocations within a portfolio. We've got a hedge finder that helps you reduce risk by finding hedges. And we've got a backtester that allows you to backtest each of these modules and see how they would have worked with your portfolio if you had used them over time. And in beta testing right now is the Event Analyzer, and that's what I'm going to be telling you about today. Okay, now let's step back for a second and let me tell you about the kinds of questions we want to be able to answer and what drives our motivation for creating this Event Analyzer. We'd like to be able to answer questions like, what happens to small cap stock prices after they touch a 52-week high? You know, if you watch CNBC, you'll see people talking all the time about 52-week highs, 52-week lows. When they hit the low, they always go up. When they hit the high, they always go down. Well, do they really? You hear about relationships between airline stocks and oil, and you know, if oil prices go down, airline stock prices will go up. Well, do they really? Other questions are, what happens after major world events like hurricane makes landfall, does that drive hotel stock prices up or does it drive them down? What about insurance stocks? These are all the sorts of questions that event studies and our event analyzer is aimed at answering. So we assume here, and so I'm going to get a little bit academic. We assume that information moves markets. Of course, we see, when news comes out, if Bernanke says this or that, bonds go up or down. So we know that news has an effect, but are we able to capture that effect? Can we take advantage of it? Can the regular investor take advantage of it? Where does this information come from? Well, there's all sorts of information. The primary sources that we look at and that are available to our to us at Lucena are things like historical price and volume. Those come from the exchanges. SEC filings. That's a source of most of our fundamentals, earnings, filings about changes in the board, and so on. Those are all available by SEC filings. Another important kind of SEC filing is insider trading. If a major if an important officer of the company either buys or sells shares, that needs to be reported to the SEC, and that information is available by essentially mining SEC websites. And of course, there's news. That's where all this information comes from. Now, can we use that information? By the time we learn it, or by the time a quote regular portfolio manager learns about these things, the information may have already affected the stock price. And in fact, there's this part of finance theory called the efficient markets hypothesis that asserts mainly that that the markets respond so quickly to news and that prices are built into, or I'm sorry, that information is built into stock prices, that essentially you can't take advantage of that. Let's take a look at it a little bit more deeply. Now, there's three versions of this efficient markets hypothesis. There's the weak, the semi-strong, and the strong. And I'm basing this on an article at Wikipedia that really has good coverage of the efficient markets hypothesis and finance overall. So you can go there and learn a little bit more if you like. But let's look at each version of this efficient markets hypothesis. The weak one says that future prices cannot be predicted by analyzing historic prices. In other words, if you look at for a particular stock how its price has changed over time, there's no way that, at least according to this hypothesis, there's no way that you can use that to predict a future price. Now, if that's true, it means that essentially technical analysis can never work. That's a strong claim, but that's the consequence if the weak version of the efficient markets hypothesis is true. Okay, let's look now at the semi-strong. Okay, semi-strong is everything the weak one said plus prices adjust immediately to new publicly available information. So first of all, you can't gain anything by looking at previous prices, and furthermore, the new price responds immediately to publicly available information. If that's true, that means not only can technical analysis not work, but fundamental analysis, where you look at the fundamentals of the company, can't provide profit either, because by the time the information comes out, the price is already adjusted. Finally, the strong version of the efficient markets hypothesis says not only do prices respond and immediately respond to publicly available information, they respond also immediately to private information. And so that means even insiders cannot benefit from information. It means that technical analysis doesn't work, fundamental analysis doesn't work, and even insider information doesn't work. Now, if that's true, I don't know why, for instance, SAC Capital has been making money from that insider information. Of course, they're in trouble for it. But anyways, is the efficient markets hypothesis true? There are several uh, several folks have looked at it in different ways, and there is a lot of reason to believe actually that the efficient markets hypothesis doesn't really hold, that you really can leverage information. This is a study by Robert Schiller from his book Irrational Exuberance. Now let me tell you what this is. Um, the the horizontal axis here represents the price earnings ratio of an equity, um, and the vertical axis represents 20-year annualized returns for the same equity. And he looked at it in over let's see, 5 different 20-year periods. And so the PE ratio is a fundamental. It's the price uh, divided by earnings, and most folks believe that lower price earnings ratios indicate potentially uh, a more attractive investment. So as you go lower here, that means you've got a lower price earnings ratio, and as you go higher, that means you got higher returns. So essentially what he did here is he rolled back time, he looked back 10 years, calculated the PE ratio, then simulated buying that stock and holding it for 20 years. Now, if 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 there was no information there that could be exploited, we would expect to see these dots just sort of randomly scattered around. But you can see clearly there is a linear relationship here, meaning that the lower the PE ratio, the higher the return. So in fact, this fundamental indicator is an effective predictor of future returns. So presumably this contradicts the semi-strong version of the efficient markets hypothesis. Uh, here is another study, and this is a great paper by a guy named McKinley, and he was the first to advocate very deeply and strongly this idea of event studies. So this is from his paper where he looked at how does news, good news or bad news, affect future stock prices. Now, let me explain this chart here. So our horizontal axis here is time, and the day that a news event occurs, a news story comes out, is represented by this vertical line here at 0. Now, what he did is he looked at thousands of stocks and thousands of news events, and he looked at both what happened to the stock price leading up to the news event and what happened to the stock price after the news event. So let's look at that. So the triangles here, those represent on average what happened to stocks relating to those companies that had bad news. So and the diamond up here are for good news. The squares here in the middle are for companies for which there was no news, and that's just kind of a benchmark so that we can compare and sort of I guess it's a control is a better term for that. So for companies for which there was no news, it just cruises on past that event as if nothing happened, and indeed nothing happened. But for stocks for which there was bad news, look, goes down. And not only does it go down, it goes down sharply on the day of the event. But what's interesting also here is the stock price is creeping down before the event. So apparently there's either information leakage, perhaps insiders, or um, just in general, folks are uneasy about the company. Then the actual bad news occurs, and boom, you see that downward spike. Now there's at least 2 days here of downward movement. So this implies that when bad news comes out, indeed one could act by shorting the stock, and maybe you couldn't get this first day move, but you could perhaps get this second day move. Something else that's interesting about this chart is that going forward in time, you see that the stock prices tend to revert back upward. So this is, to me, indicative of perhaps that on negative news, uh, the market tends to overreact. But that's not a strong conclusion. That's just an observation here. Now, if we look at, let's look at what happens with positive news. Again, a positive upward movement, and it extends for 2 days. But after that, It's just kind of flat. Anyways, this is a pioneering study on the relationship between news and stock prices, and we see that uh, A, bad news causes prices to go down, and it causes them to go down for more than just one day. Good news causes them to go up, and we see that for more than just one day. So indeed, one can presumably act on news. Now, here's how a little bit deeper. So event studies are part of our product and something we work with every day at Lucena. And here's how we build them. Um, here's how we study events. First step is you need to define the event. In other words, here's one example. Uh, let's define the event as the Dow drops 3%, and the individual stock that we're interested in looking at also drops, but it drops more than the Dow. So the hypothesis here is that some stocks are sort of beaten down a little more than they deserve when the market goes down, and that they'll recover afterwards. So we've defined our event. Now we need to define the universe. So which group of stocks are we going to look at to see how they respond to this event? In this, as one example, we might look at the Russell 200. Next step, and this is where it gets complicated and takes a significant amount of computing power. You need to look back over the time period you're conducting this study and find for each stock that satisfies this, for which there was an event, for each day in history, you need to collect that price data. So that's what we represent here with these with this red, green, and blue here. So for this stock, it had an event on that day. This stock had an event on that day. This stock had an event on that day, and these might be completely different days. In other words, this stock dropped more than the Dow on a particular day, but this green one didn't. So we're looking just at the particular stocks in the particular days where they dropped more than the Dow. We take the price history before the event, the price history after the event, and we combine all of them. And in this particular event study, we had 1,700 events. We combine all of them to create this chart down below. And I'll dig into what that chart means in just a second. Here's what that chart looks like. So this dark blue line represents the average price for all the stocks for which one of these events happened. So we're looking across, this happened 1,700 times to different stocks on different days, but we've collapsed them all into this one analysis. Day 0 is the day that it occurred, that the Dow dropped 3%, and the particular stock we're looking at dropped even more. And then going forward, we see how the stock's price responded. Now you can sort of sanity check this by looking right here. You see the significant drop down. That looks like perhaps as much as a 9% drop. Well, we know we're looking for stocks. We're not looking for situations where the stock dropped at least 3% because they had to go drop more than the Dow. So we're not surprised to see that. But look at this. As we go forward in time, the prices rebound. And in fact, we see perhaps as much as a 4% recovery from price in this case. And these upper and lower lines are the upper and lower confidence intervals. It's one standard deviation for the for those who are statistically minded. Now, this I'm not suggesting that this always works. That wait for a 3% drop in the Dow and look at which Russell 3000 stocks dropped even more. We would need to look at that in the context of more recent data. But that's exactly the kind of power that our event analyzer provides. It lets you ask questions like that and run these sorts of studies yourself. Let me show you another example. And I think this one is really interesting. It's about insider buying and selling. Now, the data for this chart, this chart was computed by us at Lucena Research, but we're using data by a company called Insider Insights. John Moreland is the one who has developed this data. Now, the blue line represents the response of stocks when there is a report of insider selling, and the green line represents the performance of stocks for which there was insider buying. And these buying and selling events are all reported to the SEC and collected and analyzed by Insider Insights. Now, a couple interesting things to look at here. First of all, as you would expect, when we hear about insider buying, the stock price continues up after that event. And when we learn about insider selling, the stock price continues down after that event. But what is a little bit more interesting is the response to buying is a bit more pronounced than selling. So perhaps the buying signal is more interesting and usable than the selling signal. Something else that is interesting is the rise in price begins actually before the event. So about 3 days before, we see this price start to come up. Now, why is that? Well, in talking with Mr. Moreland at Insider Insights, we discovered that sometimes there's some delay in the reporting of the information from the actual event of, the buying event. And more recently, the folks at Insider Insights are able to minimize that time significantly. But in some of the older data, it could be as much as 3 days between the actual event and it being registered. So this represents actually a lag in information or time and information. But anyways, these are Insider Insights are one of several proprietary data feeds that we're accessing at Lucena Research, and by combining these, for instance, we can see significant power. For instance, by asking questions like, okay, suppose there's insider buying and the PE ratio is less than 5. Those are sorts of questions that we can ask by combining information from multiple sources and really leverage that information powerfully. Okay, so let's recap what we've covered here. We reviewed what the efficient markets hypothesis, and we looked at a couple examples that seem to contradict it. In other words, the news event study that I showed you, Shiller's PE ratio study, and this insider trading study I just showed you. All three of these, to some extent, say, actually, there really is information there that one can leverage to improve the return in their portfolio. So there's reason to believe that indeed information can be exploited. And key and what we're excited about is being able to bring the power for you to conduct these event studies yourself. In other words, if everybody's running the same event study and discovering the same thing and using it to trade, essentially the power is taken away from that. If everybody's exploiting it, it's not available. You can develop your own unique studies and find corners of the market, pieces of information that combine together to show great performance. And that's what our event analyzer is all about. Now here's a we're in beta test with it now. This is a screenshot of what it looks like. You can build various studies yourself over here and name them appropriate names. Here you define the parameters of the event. I'm looking for dates when oil drops, and then I want to look at the universe, say, of airlines. And you'll see a report of all the events that occur over here. And then here's a representation of that chart I was showing you that shows the performance both leading up to the event and after the event. So this is going to enable you to ask your own questions. How do airline stocks respond to drops in oil prices? How do insurance company stocks respond after a hurricane? You can even dive into relationships between one company and other companies. For instance, you could investigate, hey, if Apple's stock price surges, what happens to the prices after that to companies who are Apple's suppliers. You can ask all those questions with this tool, and we're really excited about that. So we'll be announcing soon the follow-up webinar where we'll dive in and show you, us running this event analyzer live demo. So stay tuned for that announcement, and please watch it when it comes out in just a couple of weeks. Now, before I finish up, I'm going to take a look and look for questions. If you have any questions, go ahead and put them up now. Somebody says, Wall Street people say buy on rumor, sell on the news. Well, you know what? That's something you can test with our system. Okay, let me finish up here now. First, if you'd like to try QuantDesk, go to our webpage, lucenaresearch.com, and put in your information there, and we'll follow up with you and help you get started. Now, I want to say that the event analyzer that I just showed you is still in beta, so it's not going to be available for a couple weeks. But if you want to try the other components of QuantDesk, please give it a shot. Do one more check here for questions. Okay, we've got a bunch of questions. What machine learning techniques do you employ? Well, for the event analyzer, one thing we do that is really cool is after we provide you an analysis of, we show how stocks respond to events, we do an additional analysis where we look at all of the potential indicators we have, and we analyze how predictive each one of them is. The details of how we do that analysis is actually proprietary, but in addition to just showing you, how the price responds, we provide an additional machine learning step to help you separate the winners from the losers. With regard, let's see, just stepping through the questions. One person asks about what sorts of information is currently integrated with our system. We've got fundamental data, which is public. We have insider trading from Insider Insights. We also have a unique data source that is a supply chain analysis. In other words, we know which companies are suppliers to other companies, and we'll be rolling that out shortly as well. We have about 200 technical indicators available, and we're looking for more opportunities to add other data as well. Two of those that I just mentioned are proprietary and are cost extra, above our regular fees. Somebody asked if this webinar will be available for later watching. Yes, just go to lucenaresearch.com/media, and we've got links to all of our webinars there. Okay, let me wrap it up now. Thank you very much for your time, and stay tuned. We'll alert you again when the next webinar comes up. And again, that next webinar is going to be highlighting our event analyzer, showing you real life examples of how to use it and how to leverage it for successful investing.